Why is it that investors weren't impressed?
Well, first of all, I just want to say the growth we've seen, 7%, is encouraging. It's the stabilization of growth. It's the stabilization of growth after a long period of sequential decline. And it's the stabilization of growth after you've seen the government take specific stimulus measures to revive the economy. You've seen 4 cuts in interest rates. You've seen 150 basis point cut in bank reserve ratios. And you've started to see liquidity in the economy react to that. Very encouragingly, in June, we saw M2 up about 12%, and we saw about $200 billion of new loans extended by the banking system. That was about 20% above expectations. Why does the stock market not take encouragement from that? Very, very simple. In China, the stock market is not the economy, and the economy is not the stock market. In the US, we're very used to thinking of the stock market as a discounting mechanism for corporate and economic fundamentals. In China, the stock market is still a predominantly retail-driven phenomenon. It's been very much a speculative phenomenon, driven by greed on the way up, driven by fear on the way down. And what we're seeing now, I think, is just that process settling down a little bit. But the market here, I don't believe, is really reacting to these numbers. It's just digesting the massive turmoil and volatility we've seen in markets in recent months.
But if you look at how GDP, how the economy in China has been performing over the past year, 2 or 3, there has been a gradual decline in GDP. You can't deny that.
Oh, no, I'm saying that's what we're seeing is growth is now stabilizing after a long period of sequential decline. So that, to a certain extent, is encouraging. If the market starts discounting that, then we should see the market recover. The problem still with the market, and I'm talking specifically about the China A-share market, this is the Shanghai and the Shenzhen market, which is not closed to foreign investors, but still relatively hard to access. Valuations there are still ahead of fundamentals. If you look at the market valuation, it's trading on 16 times. That's 16 times forward earnings for a market that's likely to grow about 7% earnings growth in 2016 is looking rich. But when you dig beneath the surface, you see the problem. If you look at some of the banks and some of the energy companies and some of the old state-owned industries, the smokestack industries that China's growth has been relied upon, those are trading at reasonable valuations, single-digit multiples. If you look at some of the new economy sectors, they're still trading 50, 60, 70 times earnings. If you look at the median valuation in the Shanghai market, I think it's still above 60 times forward earnings. That's the problem. The market is still divorced from fundamentals. So you can't necessarily link declining growth or improving growth in immediate moves in the stock market in China.
You know, in 2007, now he's China's prime minister. He said that the GDP data that came out of China is unreliable and should be used for reference only. You know, there is this thinking that China cooks the books, and especially after all the turmoil going on in the markets in China and its economy slowing down, the thinking is the 7% figure maybe shouldn't be trusted.
Well, 7% has been stated as the official desired growth rate, and you know, you have to admit there's a little bit of irony in the fact that it came out at 7% when China is looking to shore up confidence. What I believe is the direction is always correct here, even if you doubt the absolute level. After several periods of decline, we're starting to see stability. The big question, though, this is 1 month of data. To know that we're either at stability or at a turning point, we need to see either sequential improvement or at least more months of stability. And one very real concern, don't forget, the market only peaked in mid-June. There is going to be some fallout from that collapse in the market. I don't believe it's going to be huge. The wealth effect was never very pronounced on the way up through the stock market. I don't think it's going to be a huge depressant on the way down. And remember as well, year on year, the market is still up, I think, 75%. So I think the wealth effect could still be positive. But if we're looking at the next month's data, people are going to be looking at month-to-month numbers here. Next month could be a little bit weaker. We've already started to see weakness in auto sales. Some of the big international auto companies have started to announce weak numbers. I think the China Automobile Association last month announced auto sales down 3% year on year. So we're inevitably going to see some fallout from that. So next month could be a little bit weaker, but once we start seeing stability or an improvement, you know, that's when I think we can start to look for the market ultimately to start discounting that improvement in economic fundamentals.